Imagine, for just a second, the ultimate high-stakes financial thriller. Picture a quiet, completely insulated, dimly lit Wall Street boardroom. And sitting right at the center of that massive mahogany table is an absolutely invincible titan of finance. We're talking about a master detective of the markets, a guy who basically never loses a major battle. This is someone with a completely flawless track record of peeling back the layers, exposing massive corporate frauds, and predicting earth-shattering financial collapses way before anyone else even sees a tiny crack in the foundation. So this mastermind, he spots his next target. He runs the numbers, and the math is crystal clear. The fundamentals? Terrible. The leadership of this target company acting totally erratically. So he sets his trap. He bets billions, literally billions of dollars, that this company is just a house of cards, completely ready to collapse. It is a sure thing, right? A guaranteed, legendary victory to add to his resume. But instead of walking away with the prize, he walks completely blindly into an absolute massacre. Welcome to The Explainer. Today, we are unraveling a financial mystery of truly epic proportions, and you're not going to believe how this one plays out.
So this brings us to the central mystery we are dissecting today. What actually happens when the smartest guy in the room gets it completely, utterly wrong? How does a legendary investor, a man who predicted the biggest banking collapse in modern history with absolute surgical precision, place a massive, meticulously researched bet, only to have it result in an unprecedented, catastrophic financial disaster? We aren't just talking about, a bad day at the office where you lose a few bucks. We are talking about a fundamental, violent clash between rigid, old-school financial mathematics and an entirely new breed of market momentum. It's a story packed with massive egos, stubborn numbers, and what might be the greatest misunderstanding of the modern market we've ever seen.
$38 billion. I really want you to just let that number sink in for a second. That is not a typo. That is the staggering amount of financial carnage that went up in smoke for investors who took this exact same bet. $38 billion utterly vaporized into thin air. To even begin to understand how such a catastrophic, mind-bending loss is even possible, and how our Wall Street titan found himself trapped right at the center of this unbelievable inferno, we have to rewind the clock. We need to look at the complete, clueless background story of a man who genuinely thought he had the entire market completely figured out.
Section 1. The Wall Street detective, David Einhorn. Okay, let's dive into this. Before we can really grasp those billions lost, we have to meet the man who built a fearsome, almost mythical reputation as a brilliant forensic accountant.
Meet David Einhorn. He's the founder and president of Greenlight Capital, which is a hedge fund he started way back in 1996. And get this, he started it with just $900,000, half of which he actually borrowed from his parents. But Einhorn, he wasn't your average run-of-the-mill investor just playing the momentum game and following the herd. No, he was a guy who would tear financial statements apart, literally line by line, hunting for buried debts, sketchy numbers, and aggressive accounting tricks. And his track record? It reads like the resume of a market superhero. Fast forward to 2002, he stands up at a major investment conference and completely exposes a company called Allied Capital for questionable accounting. He endured a grueling 6-year battle over that call, but ultimately, he was proven absolutely right. But his real masterpiece, the one that made him a legend? 2008. Long before the global financial crisis became mainstream news, Einhorn identified massive toxic exposure hidden in Lehman Brothers' real estate assets. He famously shorted their stock at over $60 a share and publicly, loudly called them out. Within months, Lehman Brothers filed for the largest bankruptcy in human history. Einhorn made massive profits off that collapse and cemented this illusion that he simply could not fail. In the eyes of Wall Street, the guy was completely untouchable.
Section 2. Anatomy of a short. This setup. So, riding incredibly high on years of market-crushing returns, our brilliant detective spots a brand new target, and to him, it looks exactly like his past victories. But to understand the sheer danger he was walking into, we first need to understand the trap he was setting.
Now, the absolutely crucial point here is understanding the mechanics of what we call short selling. Normally, right, you buy a stock hoping the price goes up. Buy low, sell high. Simple. But a short seller does the exact opposite. When Einhorn shorts a stock, he literally borrows shares of a company from someone else, and he immediately sells them on the open market at the current high price. His ultimate hope? That the company crashes and burns. Because when that stock price falls, he can buy those exact same shares back at the new dirt cheap price, return them to the original owner he borrowed them from, and quietly pocket the massive difference. But here is the deadly, terrifying trap of short selling. If you buy a stock for $10, the worst you can do is lose $10, right? But if you short a stock and that stock goes up instead of down, your potential losses are theoretically infinite. Why? Because there is absolutely no ceiling on how high a stock price can rise. It can just keep going up and up and up, and your losses just keep piling up right alongside it.
So the battlefield was drawn perfectly down the middle. On the left side of this slide, we have Einhorn's fundamental thesis. He looked at this mysterious new target company, and all he saw was a textbook disaster. He saw incredibly high production costs, a company burning through its cash at an alarming, unsustainable rate, and management constantly delaying their manufacturing targets. To a guy who lives in spreadsheets, the math simply didn't work. It was a failing business. But on the right side of the slide was a completely different reality, a reality Einhorn couldn't quite quantify or put into a calculator. This target wasn't just a traditional boring business. It had a massive, fiercely loyal cult following. It was developing visionary technology, and it traded on massive revenue multiples purely because everyday retail investors fiercely believed in its future. It was a movement, but Einhorn, he essentially ignored the right side entirely, and he bet the farm on the left.
He was so supremely confident in his numbers that he actually wrote this in a formal letter to his investors. He said, quote, "Like Lehman, we think the deception is about to catch up. Erratic behavior suggests that he sees it the same way. Just listen to the absolute certainty in that statement. He is drawing a direct, explicit parallel between this new mystery target and his greatest triumph ever, Lehman Brothers. He is effectively telling the entire financial world with absolute arrogance, hey, I've seen this exact movie before and I know exactly how it ends."
And now for the dramatic reveal. That target he was so sure was going to zero, it wasn't a traditional stuffy Wall Street bank with bad mortgages. The target was Tesla Inc. and its highly unpredictable CEO, Elon Musk. David Einhorn, the rigid, traditional, strictly by the numbers value detective, decided to go to total war against the ultimate high-growth, highly controversial tech giant. He was taking on a company that basically represented the exact opposite of everything his financial models were built to understand. He was stepping totally out of his comfort zone, whether he realized it or not.
Section 3. The short burn begins. Musk fights back. You see, when Einhorn went after his past targets, those traditional CEOs usually fought back quietly, using corporate lawyers and PR firms. But Elon Musk, he decided to use the most unconventional weapon in modern corporate history.
Musk wasn't just going to sit back in his office and let Wall Street short sellers destroy his company's valuation. He viewed people like Einhorn as a literal existential threat to Tesla's survival. So on August 7, 2018, Musk bypasses the lawyers and the press releases, and he drops an absolute bombshell directly onto the global markets. He tweets, "Am considering taking Tesla private at 420, funding secured." Just let that sink in. This single casual tweet sent the entire stock market into utter chaos. Why? Because if Tesla actually went private at $420 a share, every single short seller who was betting against the company would be instantly, totally wiped out. Now, as we know, this tweet famously led to massive SEC fraud charges against Musk, who eventually had to step down as chairman and pay a massive fine. But in that specific, frantic moment on the trading floor, that tweet was a tactical nuke dropped directly on the short sellers.
The immediate, real-world impact of that tweet was absolutely staggering. Because of that sudden, violent, totally unexpected spike in Tesla's stock price following Musk's announcement, short sellers like Einhorn were hit with a collective $1.3 billion paper loss in a single day. One day. The tables had turned so fast it honestly must have caused whiplash in the Greenlight offices. The confident hunter who thought he had the beast cornered had suddenly and violently become the hunted. Now, what's really, truly interesting about this slide and this whole saga is how highly personal and strangely public it became between these two billionaires. Musk takes to Twitter right in front of the whole world to warn of the coming short burn of the century. He publicly taunts Einhorn. He actually mocks his German last name, translating Einhorn into Mr. Unicorn. And then, in a move of pure, unfiltered trolling, Musk actually sends a physical package containing a pair of literal shorts to Einhorn's hedge fund office. And Einhorn, to his credit, he refuses to back down. He actually tweets a photo of himself with the shorts, sarcastically thanking Musk for the gift, but making sure to note that they came with, quote, some manufacturing defects. It is just incredible. You have billions and billions of dollars on the line, people's life savings wrapped up in these funds, and the key players are publicly trolling each other over the internet with athletic apparel. But listen, beneath all the Twitter jokes and the memes, a highly lethal financial trap was closing fast around Einhorn. It's a phenomenon called a short squeeze, and it is terrifying if you're caught in it. Remember earlier how we said short sellers eventually have to buy the stock back to close out their bet? Well, when Tesla's stock started aggressively rising, short sellers started panicking. To cut their massive losses, they were physically forced to buy Tesla shares on the open market. But here's the catch. All that frantic, forced buying pushed the stock price up even faster, which in turn forced even more short sellers to panic and buy, creating this unstoppable, self-feeding rocket of upward momentum. It's like financial quicksand. Einhorn's very own strategy, the need to buy back those shares, was literally being weaponized against him. Section 4. Billions up in smoke. The market responds. This right here is the climax of our story. This is the exact moment where the fundamental, rigid math Einhorn had successfully relied on for over 2 decades was completely, utterly obliterated by the real world.
And this chart brilliantly illustrates the sheer, unbelievable scale of the defeat. As the world moved into the chaos of the 2020 pandemic era, you might think a car company struggling with manufacturing would finally collapse, exactly like Lehman Brothers did. But no, Tesla didn't collapse. It hit the absolute accelerator. Look at this. In 2020, the broader market, the S&P 500, had a really great year, up 19%. That's a solid return. But Tesla surged a mind-bending, gravity-defying 900%. 900%. This historic, unprecedented surge is exactly what created that $38 billion graveyard for short sellers we talked about at the very beginning of the explainer. It turned out no amount of brilliant fundamental analysis, no logical complaints about cash burn, and no deep dives into accounting practices mattered in the slightest. The market had spoken loudly, and the momentum of the crowd was absolute.
Section 5. The bitter aftermath. Greenlight's paradox. So returning to that dimly lit boardroom, what on earth do you do when the entire market behaves in a way your brilliant models explicitly say is impossible?
The final result of this showdown was a piece of dramatic irony that we like to call Greenlight's paradox. Check this out. In the fourth quarter of 2020, at the height of this madness, Einhorn actually generated a massive 25% gain for his fund. He had a great quarter. But how is that possible when his biggest target was rocketing to the moon? Because he was forced to retreat. He quietly, painfully reduced his short position right before Tesla was officially included in the S&P 500. He basically had to actively duck and sidestep the massive Tesla stock rally just to survive the year. Yet, despite his fund's overall positive finish on paper, Tesla remained the absolute largest, most painful loser in his entire portfolio. The invincible, untouchable detective had technically survived the year, sure, but he had to literally run away from the fight to do it.
But if you think David Einhorn just folded, conceded defeat, and admitted his math was wrong, well, then you really don't know the value detective. In his Q4 letter to his investors, after taking this historic beating, he wrote this: "The fad is in owning Tesla stock. 20 times a silly price is still just silly. It's incredible. Despite the crushing financial defeat, despite the actual billions of dollars lost by short sellers globally, Einhorn remained entirely, ideologically steadfast. He basically acknowledged that, okay, Tesla the car company isn't a fad, they make real cars. But to him, the stock valuation absolutely is a fad. He still deeply, truly believes that his fundamental math is correct and that the entire global market is just experiencing a temporary bout of insanity." Which leaves all of us with this final, highly provocative thought to take away today. When rigid, purely logical financial math, the kind that spots frauds and predicts recessions, clashes head-on with undeniable, incredibly powerful retail-driven market momentum, who really dictates the true value of a company? Is it the spreadsheets, the cold hard numbers, and the forensic accounts in the boardrooms? Or is it the crowd, the visionaries on Twitter, and the sheer unquantifiable belief in what a company could one day become? It brings up the ultimate age-old Wall Street question. Can the market stay irrational longer than a certified genius can stay solvent? Think about that the next time you look at a wild stock chart. Thank you so much for joining me on this explainer. Keep questioning the numbers, keep looking behind the curtain, and I'll see you next time.